Hello, friends. So, Greg with Money Monk here on another edition of Viewer Question Friday, where I attempt to answer the questions that you have about money. If you ever have a money question, just submit it in the Google form, which I will link in the video description below. This week's question is about exchange traded funds versus mutual funds. So, the question is, which one should I be buying, an ETF or a mutual fund? What's the difference and which do I prefer? So, let me give you the answer in about 30 seconds. And then I want to explain the answer because I think there's some important information to understand about how I came to this conclusion. For me, ETFs are better in almost every single way. And so that's what I use. And I would always recommend going with an ETF versus a mutual fund if an ETF is available. But neither of them are bad options. And really, the differences between the two are minimal enough that I wouldn't say if you have mutual funds today that you need to sell them to get an ETF version of whatever that mutual fund is. But ETFs do have important benefits that if I were just starting today, I would start with an ETF. And so the rest of this video is going to actually explain why I come to that conclusion and why I prefer ETFs so that you can make an informed decision. Okay, so here are the three things that we're going to cover. The third one has four different things we'll talk about. We're going to talk about what is an ETF and what is a mutual fund. How do they work? And then based on how they work, which of them is better? Okay, so for me, the easiest way to think about an exchange traded fund or a mutual fund is that they are just baskets that hold investments inside them for an intended purpose. So literally, I have my props here. So imagine that you have two different bags that are going to hold your groceries. Here I have a Sprouts plastic bag or an Aldi's, I don't know what kind of material this is, but you have two different bags. They each do the same thing. They're going to hold the groceries that you put in them. And so the question is that if you go to like your investment supermarket and you start putting investments inside these bags, which one would you prefer? So you can think about the stock market as your investment grocery store. So we're going to the stock market and we're going to buy some investments. So let's say that you wanted to buy the S&P 500 as an investment. So the S&P 500 is just simply the 500 largest companies in the United States. Often you're going to hear a term called an index fund. And what an index is basically a benchmark for a group of companies or a group of investments. So for instance, the S&P 500 index fund is the 500 largest companies over time that you are tracking performance to. I'm not a huge sports guy, but an analogy might be, let's say you watch college football and you wanted to track an index of a group of college teams. So, for instance, the Pac 12 is a group of college football teams in the Western United States. So, you could say the Pac 12 is an index for a group of teams. And so, if you wanted to track average performance stats of a group of football teams over time, you might say, I'm going to track the Pac 12 index fund. Or you might say, I want to track the SEC, which is another group of teams. Or you might say, I'm going to take all college football teams over time, and that's going to be one massive index. It's kind of the same thing as investing. So you can have an index fund for the top 500 largest companies. You can have an index for the top 100 largest companies, or you can have an index for the entire stock market, which are all companies. Or you might have more active investors that have a group of investments that are trying to beat the average performance of these benchmarks. All right, so going back to our bag example. So let's say I could take my Aldi bag and I could put the 500 largest companies in here. So I'm buying shares of Apple, I'm buying shares of Microsoft, and I'm continually adjusting the amount of shares of each company based on their size and their market performance. So that each of the dollars that I have invested in these companies is weighted to the size of the company in proportion to the size of the entire index or 500 largest companies. A mutual fund or an exchange traded fund is basically going to hold all of those investments and do it for you. So going back to like my original definition of what a mutual fund or exchange traded fund is it's a basket or a bag that's going to hold a set of investments for an intended purpose. Okay, so let me pull up an example of the S&P 500 index fund in a mutual fund bag or an exchange traded fund bag. So here I am on Vanguard's website. And here you have a ticker symbol, VFIAX. And I think about ticker symbols as almost like a description on a restaurant menu. So if you like go to a restaurant and you're looking at chicken parmesan or something. VFIAX is basically just describing that menu item. And then the ticker symbol is what you would use to buy or sell a share of this fund. So, anyways, VFIAX, it's a mutual fund and it buys the top 500 largest companies in the United States. So, going back to the index, this is the S&P 500 index, and you'll see where they call that out at the side here, product summary. As the industry's first index fund for individual investors, the 500 index fund is a low-cost way to gain diversified exposure to the US equity market. It offers exposure to 500 of the largest US companies. Okay, so that's the S&P 500 in mutual fund form. And then you have the same S&P 500 in ETF form. So here is VOO, which is an exchange traded fund. Normally, you will see an ETF classified in the description. Here you can see it, Vanguard S&P 500 ETF or exchange traded fund. So it's the same ingredients that are being put in each bag. The 500 largest companies. It's just that one is using a mutual fund bag, and then the other is using the exchange traded fund bag. So then going back to the question, well, Greg, the investment is the same. Why does the bag matter, or how are they different, and which one should I use? And that gets us into part two, where we're going to talk about how do these different bags work. So a mutual fund is a much older investment vehicle. In fact, I didn't know this until this video, but the history or origin of a mutual fund, in case you have like Friday night trivia, was that it was created in the Dutch Republic in 1772. And the first business person created a fund called Unity Creates Strength. And the idea behind it was that a bunch of regular people or smaller business people or investors pooled their money together, and then they were able to buy something collectively and share in the profit of whatever it was. So you can think about a mutual fund as a gigantic pool of money. So every single day, a mutual fund is pulling in money from a large collection of people. It's pooling it, and then it's investing that money in accordance with whatever it's supposed to invest in. Similarly, it's also pulling money out as people leave the pool. And so that continual pooling of money has subtle impacts on the way a mutual fund operates for you that we're going to get into. And before I get into those, let's just talk about an exchange traded fund. So, an exchange traded fund is a newer investment vehicle. And instead of pooling money from a bunch of different investors, think about it more as like a one-to-one relationship with whatever the investment vehicle is. So, for example, the S&P 500 ETF is really this passively managed bag. And so when I buy a share of an S&P 500 ETF, it's just me. And so that dynamic of pooling money from a bunch of buyers and paying people as they leave their money back, that has no impact on an ETF. It's really a one-to-one interaction, a lot like you just going out and buying a share of a stock. And so you'll hear a lot of times that an ETF trades similarly or really identically to the way a stock trades. And that's because it's just you and that individual security. Okay, and so that's how they operate. So the question is, which is better for you? And so we're going to look at this in four different ways that I think are the most important. Okay, so let's talk about tradability. So a mutual fund is only going to trade once a day. It trades at the end of the day after the market closes. So what's going to happen is this big pool of money, a fund every single day is going to account for all of the money that's come in, and then it's going to account for all of the money that's leaving as people sell shares in a mutual fund. And then they're going to deploy that money, whatever's left in the pool, across the different investments that they are mandated to purchase, like the S&P 500. After all of that's said and done, then the mutual fund is going to be priced at something called the net asset value, which is basically the value of the underlying companies. So in the example I'm using, the 500 largest companies, divided by the number of shares outstanding in the mutual fund. And that's the price that everyone is going to receive at the end of the day. So this has some positives and negatives. I think for me, it's mostly negative. So let's say you wanted to exit a fund, you click sell on your mutual fund at 9 a.m. or 10 a.m. and you want your money. Well, that trade is not going to execute until the end of the day. And then really your money is not going to be available until after it executes, and most likely the following day. So there's a huge lag between when you might want to enter or exit a position in a mutual fund and when it actually happens. And that's because of the way a mutual fund works with this pooling of money. On the other hand, an ETF, because it's you just one-on-one instead of this pool of people executing a trade, it trades like a stock. So if I wanted to sell my ETF at 10 a.m. on Thursday, it's going to sell at 10 a.m. on Thursday almost instantaneously. It's going to trade just like a stock does. Now, I am a passive investor. I'm not an active like day trading investor. And so it's not really important to me that trades execute quickly, but I still do like the convenience of an ETF, knowing that if I wanted to sell something right away, I could sell it right away. I don't have to wait multiple days as a trade executes. Now, this opens up a larger can of worms that I'm not going to get into in this video, but because you can implement an order throughout the day, you depend on your brokerage, so like Fidelity, Schwab, Vanguard, or Robinhood, to basically execute that trade efficiently. There's an idea around fill quality or fill order quality. And so really what this means is that some brokers brag that they are able to fill an order more effectively and really efficiently than other brokers, meaning let's say a stock or a share trades at $100 at whatever time you're in during the day, and where they implement the trade kind of in the back end of all of these trading systems, you actually get $99.90. So there was actually kind of a hidden fee there because the quality of the order doesn't accurately reflect what the value of that share actually was. Some brokers will brag that they can actually get a better fill quality, meaning let's say that the true value at that time is $100. They fill it at $100.05 or 10 cents. You're actually getting a better deal on the share that you're purchasing. The nice thing about a mutual fund is you don't really have to worry about the fill quality of an order because really everybody gets the same price at the end of the day. Really, that's such a marginal issue if you are not a super active investor trying to buy and sell ETFs and time the market constantly throughout the day, and you're just buying like every 2 weeks or whatever is in accordance with your investing plan. The hidden fee, quote unquote, of how well an order fills could be relatively small. And if you have a broker that does it well, you could actually be coming out slightly ahead. Although on the other hand, it could be a pretty big thing if you actively trade a lot and you have a portfolio of a couple $1 million and you're trading hundreds or thousands of shares of an ETF constantly, then the fill quality does matter. And that's going to be a drag on your performance if that broker doesn't do it well. Anyways, so I give the thumbs up to an ETF there because really it's more convenient for me to be able to buy and sell. And it gets into point two, which is portability. The idea of portability is basically if I wanted to transfer, let's say I wanted to transfer my investments from Fidelity to Robinhood. So Robinhood does not allow you to hold mutual funds at Robinhood. So let's say I had a bunch of S&P 500 mutual funds at Fidelity and I wanted to port or move my money over to Robinhood. Well, I would have to sell out of all of those mutual funds and buy the equivalent ETF investment. The problem with that is that if you're an investor and you invest for 10, 20, or 30 years, you're living in good times where your investments have been growing over time, that can carry with it a massive tax burden if you're investing in a taxable brokerage. But if you do have a taxable brokerage, an ETF is going to be much more portable than a mutual fund. You don't really have to worry about if I wanted to move my money, could I? Okay, so that's point two. So ETFs, they can trade quicker throughout the day. They can move from broker to broker. The third thing is expenses and fees. And I think this is where if an ETF hasn't already outpaced a mutual fund in the first two examples, it really does here. And let me show you why. So when we talk about fees, you always want to do your own homework. I'm going to paint with kind of a broad brush here. In general, a mutual fund is going to have higher fees than an ETF. And so if you ignore everything else about which one you prefer, I would always opt for an ETF because they're generally cheaper. I'll give you two examples with Vanguard. Again, I'll go back to the S&P 500 VFIAX, which is actually, this is a funny distinction. This is Vanguard's Admiral Shares Fund. And what that means is that typically to participate in this mutual fund, you have to invest a minimum amount of money. So in this example, you have to invest at least $3,000, which you can see here on the right. And the expense ratio is already almost free. It's very minimal, so I'm not that worried about it. But it's 0.04%. Well, let's compare that expense ratio to the equivalent fund again from Vanguard, VOO, the S&P 500 ETF. It's actually less at 0.03% as an expense ratio, and it doesn't have a minimum requirement to buy. So this is true for basically all ETFs, is that they're not going to have minimum investment requirements. So if you wanted to buy $1 worth of the VOO ETF, like at Robinhood or any other brokerage, you can typically now buy fractional shares. So as an example, here you have VOO, one share is priced at $604. Not so long ago, let's say you wanted to buy a share of VOO, but you didn't have $604. Well, you had to wait and buy in multiples of a full share. Well, now you can buy fractional shares. Maybe at the end of the week, instead of spending $100 at the bar going out, you're going to say, hey, I'm going to protect that money. I'm going to invest it. You could buy a fractional share of VOO at $100. Not so with the Admiral shares. You would have to actually wait until you had a minimum amount to invest, and then you're also paying more for it. So for me, an ETF just wins out pretty much there all the time. Mutual funds can carry other fees with them, so there can be fees for buying. You can pay fees for leaving. Because it's many people investing in a pool of money that goes to a fund manager, sometimes there's fund management fees that are charged. Whenever you're looking at a mutual fund or an ETF, you always want to read the fund literature. Now, a broad brush of saying mutual funds are always more expensive is, I want to be careful about that, because like here I'll go to Fidelity. So Fidelity has zero expense ratio mutual funds. So here you can buy a mutual fund with no fees at all, which are incredible. The disadvantage, going back to portability, is that if you buy a Fidelity mutual fund and for some reason you decide to leave Fidelity one day in your like taxable brokerage account, you couldn't take these mutual funds to another broker. And so then you would have to sell them. And so if there's a profit, you could potentially have to pay tax on whatever the gain is. For me, that limit of flexibility is enough for me to not invest in Fidelity Zero funds, because I would rather have an ETF that is portable, and the fees are generally so low on an ETF is that it's really so marginal, and really you can't even see the performance difference if you back test these funds, that I don't really worry about it. Okay, and then finally, let's talk about any type of tax implication between a mutual fund and an ETF. So exchange traded funds are more tax efficient than mutual funds. And it comes down to, again, the structure of how these things are set up. So going back to the mutual fund, it's a bunch of people pooling their money together and then putting it into an investment. The reason that a mutual fund can trigger unintended taxes for the people that hold it are if a large amount of people decide to take their money and leave the pool all of a sudden. Because what a fund manager is going to have to do to pay the people their money is they have to sell the underlying portions of the assets that it's holding. And if a fund manager is forced to have to sell a significant portion of the investment to give that money back to the investors that are leaving, what happens is it triggers a capital gain tax on everybody in that pool. And I'll give you a few examples of this. So this was an article in Morningstar. The question is, do I have to pay tax on mutual fund capital gains even if I don't sell any shares of the fund? And the answer is yes. So if a significant amount of people leave and the fund has to liquidate investments to cover the people leaving, that impacts everybody. And I'll give you an example. Vanguard has been on my naughty list lately. They're really supposed to be kind of the brokerage for the little people, but more and more I feel like they're doing things that are not friendly to the little guy. And so what you'll see here is Vanguard was fined over $100 million by the SEC related to mutual fund capital gains tax. And I'll explain this simply. Basically, Vanguard had target date retirement funds, which have tons of money in them, and it's a effective and simple way to plan for retirement. You pick the year you want to retire, and you put money into that one mutual fund, and then a fund manager manages the portion of stocks or equities to bonds, while slowly converting into bonds as you get closer to retirement, which lowers your risk. Okay. But then what Vanguard did is they had institutional target date retirement funds. And typically, like an institutional fund, it requires a much larger amount of money to put in, but then you get favorable expense ratios and other things. So Vanguard had an institutional fund that required $100 million as a minimum to invest. Well, they significantly decreased the minimum requirement to invest down to $5 million. And so what happened is all the institutional investors that had money in target date retirement funds that you and I, as retail investors, hold, they moved their money. They sold out of that pool and they bought the institutional funds. Well, because so many institutional investors left the target date retirement funds that you and I hold, it triggered a massive capital gains tax on everybody that was holding that mutual fund. And so I believe it was a class action lawsuit, because why do I, as a retail investor, have to pay a capital gains tax to cover all of these institutional investors leaving and buying a better, more effective retirement date fund that I can't afford, that these institutional investors now can, because Vanguard basically cut the legs out from their existing target date retirement funds. So that's one example of capital gains being triggered on retail investors through no fault of their own. Other examples happen infrequently, and I do want to stress this is an infrequent issue. It is a marginal issue that, again, it's not a big enough deal that if I'm in mutual funds today, like I'm liquidating my mutual funds and getting into ETF. So I don't want to leave that impression with you, but it can happen, and it does happen. So with an ETF, you really don't have to worry about any of that. It's a basket of goods holding your investments, and it's just you and that specific ETF. It's nice because you're in full control over when you might trigger a capital gains tax, depending on when you decide to sell, and not the other people that have decided to sell and get out of the pool of money. Now, one little nuance I want to call out at the close of the video. So if you are a dividend investor and you have dividends paid out in an ETF, you're going to depend on the brokerage, if you have automatic reinvestments of your dividends set up, on the quality of those fill orders, like we talked about before. And so this is something called the dividend reinvestment programs. Each brokerage will typically have a drip program, and the way they operate are all slightly different. And I've not found good research on which drip program is better than another. That might be a future Money Monk project where I just take kind of anecdotal tests of dividend reinvestments. I have a general bias that says Fidelity and Schwab have really the best dividend reinvestment programs. I've seen anecdotal evidence that shows that Robinhood's is not good, but I don't have enough to back that up in a way that I feel comfortable saying one way or the other, this is a sure thing. But the simplification on a mutual fund is that when you have a dividend payout, it's going to rebuy at whatever that NAV price is at the end of the day for whatever mutual fund you're in. And so that kind of eliminates the potential for a broker to kind of fluctuate the quality of a purchase, because it's really just locked into a NAV price. A popular dividend fund is SCHD, Schwab's dividend fund. I really like SCHD. Might be something that I'd put money into one of these days. But if you have a dividend fund in an ETF form, then I care much more about the broker I'm with and the quality of their fill orders and how they do dividend reinvestments. And I have to pay more attention to that part of it than just the difference between an ETF and a mutual fund. So this just adds a little bit of nuance. It's not the biggest deal either way, but as always, I try to be complete and give you as full of a perspective as I am able to muster. So those are the reasons that I choose to invest in ETFs when possible: better tax treatment, quicker trades, generally lower fees, and it's easy to move them from broker to broker, so you're not locked into one brokerage over the other. But again, I do want to stress before I end the video that either of them are really okay. This is more of an optimization conversation, so it's not the most important thing to be worrying about if you're a new investor. And if you're in a well-diversified mutual fund, index fund, there's nothing wrong with that. An ETF might be better in these key ways. But either way, if you're in a low fee mutual fund or a low fee ETF and you're following a sound investment plan and you're well diversified and you understand your investment goals and you understand the risks and you're consistent over a long period of time, I think you're going to be successful either way. those are the things that I would be focusing on more than some of this optimization. But it doesn't hurt to start out with a better investment vehicle, and I think it also helps just to understand the differences so that you're more well educated and can kind of understand the different nuances as you expand your financial education. So that's my take on the ETF versus mutual fund debate. I'd be curious to hear from you if you prefer one or the other, and if you have a different take around, why you might prefer mutual funds. I'd love to hear that take as well. So you could share it with anyone else that might be watching or trying to learn from the comments. So I wish you all the best in your investment journey, and hope you have a nice weekend.